Hello and welcome to the look ahead for Wednesday, the 15th of January, with me, Fiona Cincotta, Senior Market Analyst at City Index. So we will be watching tomorrow. I mean, there are a couple of points. There's the Eurozone industrial production. We also have UK and US inflation data. They are going to be watched very closely. And then we also have the start of earnings season in the US, kicking off with major banks. We've got JP Morgan and Citigroup reporting tomorrow. Then we also have Goldman Sachs as well as Wells Fargo reporting towards the on Thursday. So lots to be watching. But let's just start with UK inflation. UK inflation is expected to rise to 2.7% year on year, up 0.4% on a monthly basis. That's up from 2.6% previously. Hot inflation is not what the Bank of England really wants to be seeing right now. Service sector inflation, which the central bank has been watching very closely, is expected to ease slightly to 4.8%, but that's only down marginally from the 5.2% that it has been previously. So, this is not a massive difference that we'll be seeing. So we're expecting, as I said, inflation to come in hotter than it has been. This is coming at a time where we've also seen UK bond yields or gilt yields, should I say, rise to historically high levels not seen since 2008 financial crisis. Now, this chart here is sterling US dollar. As you can see, we've got the pound trading down at multi-year lows. It's down just around that 122 level, a level that was last seen back in 2023. Now, usually if we see, or on previous occasions when we've seen hotter inflation, that has led to an increase in the value of the pound because the market believes that the Bank of England on such some scenarios won't be cutting interest rates as frequently. But what's happened as we've got gilt yields extremely high, there are at the same time that the pound is falling, it suggests that there is a flight of capital from the UK, and that means that if we get hot in inflation, then we could actually see the pound fall further. Now, just having a look at what levels we'll be watching. I mean, it's trading in this descending channel as we speak. Obviously, there is a US dollar element to this as well. We've seen a stronger US dollar, but we just need to have a look at what's going on here. We've just hit the lower resistance, the lower support, of the lower band of the falling channel. That was down at 121. Now, if we just have a look at the formation of that candle, that's called a hammer candle. We can see that it's got a long lower wick, suggesting that there was little selling demand at those lower levels, and it can be a reversal, a bullish reversal candle. However, today's candle, as we're looking at it, is doji, so giving indecision. Now, if we do see, as I said, that hotter inflation, then we may see particularly, hotter than expected inflation, then we could see a further sell-off in the pound, be looking to take out that level of 121. And that brings this level here into focus, which is that 120.50, the level that we saw back in October 2023, and also the 120 round number. If we do get cooler inflation, then we could see actually a slight recovery in the pound, just coming up to that 123 level. That's going to be the immediate level to watch on the upside. That was the April 2024 low. If we can get a rise above that, that does at least sort of put some floor under the sell-off that we've been seeing. But this is interesting here because we've also moved back below this trend line, which dates back to 2007. Now, as I said, there is also an element of US dollar involved here in that action. Obviously, the US is also releasing inflation data tomorrow. Inflation in the US is expected to tick higher, up to the 2.9% year on year, up from 2.7%. Now, that is moving further away from the Federal Reserve's 2% target level. On a monthly basis, we're also expected to see inflation rise 0.4%. Core inflation is expected to hold steady at 3.3%. But this is also happening, high inflation, potentially actually before Trump moves into the White House, which will be happening in just a matter of days. Now, Trump is expected to bring with him inflationary policies. He's expected to implement inflationary policies. As a result, we've seen US Treasury yields soar. And with US Treasury yields much higher, that has actually pulled the US dollar higher. So if we see hotter inflation, then that could actually lead to a rise in the Treasury yields and a further increase in the US dollar. Now, that would be bad news for the pound US dollar that trade that we've been looking at here. If we do see hot US inflation, and particularly if we see it with hot UK inflation, then that could be a reason for sterling US dollar or cable to trend even lower. If we see cooler than expected inflation, which is again a potential, I mean, if we think about what the lead indicators are, we saw PPI out today. That was slightly cooler than expected, but it was still an increase from the previous month. ISM services PMI, the cost gauge there, was also much stronger than expected. So that sort of was what got the market a little bit nervous about inflation just last week before we saw that really strong jobs report. So inflation is definitely a concern for the market. And I think with that in mind, let's just take a look at what's going on with gold. Interestingly, gold has been pushing higher despite the fact that we've seen that US dollar strength and Treasury yields rise. Now, if we see Treasury yields rise, US dollar rise, and gold rise, that tells us that potentially the market is a little bit concerned about inflation. And it also tells us that there is a level of uncertainty, which is also helping drive that safe haven trade into gold. Now, as far as levels to be watching, we can just see this is the 100 SMA. Gold is really just tracking that 100 SMA higher. It's recovered from the low that we saw in December of 125.83. It didn't make it above the 126. The 127 level. This is that rising trend line that we've seen dated back to February 2024. So a year-long rising trend line. We fell below it sort of at the end of December, haven't managed to get back above it. If we see hot inflation, potentially we could see a rise above that level. That's the level I'll be watching, 127. We want to rise above 127. That's going to give, if you get a rise above 2700, that will bring the 2750 level back into focus, and above there, 2790. On the downside, there is potentially some support there at the 100 SMA at 2630, and then around this level here, which is 2600. Down to around the 2585 level, so a support zone there. Now, just finally, we've also got the banks are also going to be reporting. Expectations are pretty high. I mean, if we just think about sort of as far as what we were expecting to see from these investment banks, although net interest income has actually probably fallen given the fact that we've seen those cuts in interest rates, we have seen expecting to see extremely strong trading revenues and also deal making revenues, which are expected to offset any weakness in NII. However, given that the Federal Reserve is not really expected to cut interest rates next year, I mean, the market's pushed back on rate cut expectations for the Fed to 25 basis points to December. And a lot can happen between now and December. So with that in mind, the market is really pushed back on those rate cuts, which means actually the outlook for NII could be improving for the banks as well. So the thing to remember here, though, is there is a lot of expectations here. They're trading near all-time highs. Expectations are high, and that does mean that we need to have strong numbers and an optimistic outlook in order for these stocks to rally. But yeah, S&P of the S&P 500, the financials and particularly the banks are expected to outperform with their earnings. So thank you very much for joining me, and I hope that you found this useful. And then if you do have any questions, then please do reach out to me. Otherwise, we will see you back here tomorrow. Thank you for your time.